Hello, everybody. How is everybody doing so far? Welcome to the session. Today is June 1st, 2023. This is our trading and review monthly session, in this case with me, Jose. And it's going to be my pleasure, as always, to spend some time with you as we do every month, looking at the markets, looking at your questions, looking at different styles of trading, looking at different tools. Really, I'm here for you guys. The name of the session kind of says it all, is it? Trading and review. So happy to review some of your trading activities or review or discuss some of the questions that you have out of your trading activity. Happy to also look at the markets and get a bit more forward-looking or proactive, defining some sort of trade setup that may be available depending on the methods that we use. Before we get started, as always, which I have forgotten, by the way, there is a financial disclaimer in the bottom part of the screen. Please read it carefully. And in the meantime, as well, you can see on the screen that we have our Speak Up room key, which is 44537. I can see Joe is already typing there. How are you, Joe? It's very good to see you. And I would like everybody, how are you, Jeff? Good to see you as well. I would like everybody to please go ahead and type a quick message there. So that way I know we are connected, that you guys managed to get into the chat room. We keep the chats between us because these sessions are then posted on YouTube and other social media places. And certainly they can be greatly beneficial for students of trading that want to learn how to trade more and better, and they are connecting with us to do that. But of course, during these sessions, we often go over some specific let's say problems, for example, or situations that may have happened. And in that sense, in order to help everyone to speak freely without having to necessarily reveal their name, so we keep the chat box not on Facebook. We keep it only for our members who are connected with us live. Okay. If you don't know how to connect to the sessions, I'm just gonna mention it. To be honest, I never mention it, and I should. If you don't know how to connect to the session and you are new to what we do, the way to do it is, I'm just gonna bring browser window here on the screen. So the way you do it is you come to our website, tradewithufos.com, you log in, and then you can just click on live trading, and that's how you get to connect with us. Apart from connecting on live trading, which I am doing right now, on the bottom part of the screen, so here is the meeting room that will show in just a second. This offline message will go away, and here's the room. So apart from getting into the room here, as you can see, so you can also scroll down and you have a calendar where you can see when we are live and all of those things. The coaching sessions are accessible live, real time, for the ones of you who are either top traders, users of our platform top, or you are subscribed to the monthly plan. That allows you to enter the session live. If you are not, you are definitely welcome to still look at what we do. We are very transparent in that sense, but you just need to do it on our YouTube channel, and the videos are typically posted with 12 to 24 hours of delay. So the sessions are not live, even though the content is still very, very useful. So anyway, so I believe that everybody should be here now. We've been streaming for around 5 minutes, so I guess all is ready for us to get started. And as always, I would like to turn to you guys. I'm going to turn off the disclaimer as well, because I understand that everybody has seen it already. I'm going to make a bit more space on the screen. So that's it on the screen now. The protagonist is the chart, and of course, you. So I'm going to turn to you guys to ask, how is it going? Do you have any question for me? I know Mark posted a question on the forum. Maybe a good idea would be to actually bring that question on the screen, so I'll do it in a moment. But just in case Mark is here with us as well, Mark, it would be great if you could let me know if you would like me to go deeper into the question and the response you got from our support team. Let me bring this to the screen. Because again, we get together, 4 times a month, once per coach, once per week, once per coach, so 4 times a month. But you may have questions in between. So what do? So one way to get questions answered is to go to the QA forum, which is on the bottom part of the screen. You can also use the direct URL tradewithufos.com/questions. And when you get in the forum, so notice how there are many questions here. The last one on the top is a question from Mark. Mark doesn't seem to be with us today. Mark is always with us, but I guess today is not. So it's okay, not a problem. But in any case, I think it's still beneficial for everyone to look at Mark's question from the forum, where he was talking about double calendar setup, where one of the strikes he was using, he was short the 275 call. And it seemed that the stock rallied all the way to 294. So the stock went up, 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 all the way to up there, which is 294.73. So that stock, that option, I should say, was basically almost $5 in the money. And the question that he had was about distorted Greeks, which is one of the rules that we use when we are rolling the double calendars. We buy back the short units that expire at the end of the week, and we sell new units that expire at the end of the week after. So we are rolling into the next weekly expiration, and we do that when the Greeks are distorted. So the Greeks being distorted means that the value of theta is suggesting that there is more to be collected than what the premium is. In this case, the theta available was 4.15. There was 2 days to expiration. So Mark calculated that 4 times 415 is 830. So based on the Greeks, we could have collected $8.3 of additional premium just by letting time pass 2 more days, where the ask price of the option was 30. And knowing that the intrinsic value was $4.73, almost 5, so that meant that there was still, okay, there was still $19, which Mark did a little mistake on the calculation here. So 294 minus 275, that would be 18. Okay, so not 19, but 18, like that, more or less. So 18, which means that I'm not sure. Sorry, I just did it backwards. Here we go. So 19 was correct, and here it got 18 instead of 19. So my mistake here. So this should have been number 9. Okay, so it was 1973. Making this instead of 11 would have been 10. So in other words, the premium left in the option in the form of extrinsic value, meaning without those $4.73, was $10. Okay, $10.72. This is what was available. Okay, Theta was suggesting that there were still $8.30 to go, but the reality is that we got $10. In other words, at that moment in time, the Greeks were not distorted, and rolling was too soon. Okay, you could have waited maybe another day, and then the next day. Now the Greeks are distorted, and now rolling would have been just slightly more efficient. Again, with 2 days to go, it's not like the difference is going to be that humongous, but there was a little bit more to scratch when it comes to collecting a bit more of intrinsic value. In any case, here's the short version of the answer that you guys can Okay, everyone. So the question is, are you still there? I am so sorry about that. I just had a technical problem on my end. Please use the chat box to confirm that you still hear me, because to be honest, I am not sure at this moment in time if I am live or not. Okay, I would say I would say that I am back to be live, even though it seems that the camera is not working, isn't it? I just came back. Okay, sorry about that, everybody. Just give me a moment, guys. I will try to fix the problem with the camera. Give me a second here. So weird. So weird, my friends. I'm not sure what happened. But anyway, give me a moment. Give me a moment. And I believe I will be able to fix this. I think so. I think you are about to see me in just a moment. Here we go. Now I'm back. Great. Okay. Well, not ideal. Sorry about that. But anyway, Mark, good to see you, my friend. I'm like, where is Mark? Thank you for your question. Very good question, by the way. Very great example here. Not sure if you had the time to read the answer from the support team, Mark, but since you're here, let me know if anything here is not clear, and we will look at it together. But yeah, cool. So while Mark is getting back to me with that answer, you guys let me know if there is anything that you would like to address today in particular. Again, happy to get into those charts, find examples maybe of whatever is it that you've been practicing this week, where your interests are, etc., etc. Let me know what that is on the chat so we can quickly move into that type of application and maximize our time together here. So you guys let me know. Okay. If you do not have any comment, I would also appreciate that you have that written on the chat box. Maybe there is nothing that you need to check. So if you let me know that's the case, maybe I'll do some market analysis. But at least I'd like to know that you have no questions, because this is called trading and review. So in other words, I'm ready here to help you with the reviews when it comes to understanding, what are the steps that you do in your methods, things of that sort. So happy to support you from that angle. If not, we can certainly go ahead and move into more practical application of things. But also in that sense, I would like to know what type of trade you would like me to put together, because maybe some of you are trading iron condors only, some of you are trading directionally only, or maybe you're doing a mix of things and you need more support here or there. So please communicate with me so I know better how to support you guys. Again, this session is designed to be interactive, and therefore I need a little bit of your engagement so you can give me answers so I can support you better. I read the email. Mark said, I am glad to hear that I could have waited longer to roll. Could it happen that the Greeks would never be distorted? Well, I guess it could happen, but I never seen it happen. When time passes and we are getting very very close to expression, I guess that it could be that there is a collection of parameters that are aligned in a way that next thing you know the Greeks are representing exactly the reality 1 or 2 days before expression. I guess that could happen, but I've never seen it. Most of the times, sooner than later, you start seeing those distortions, if you wish. I mean, and distortion is just a term that we use just to kind of be pragmatic on how we explain it. Really, what that is not like there is a distortion, like the pricing models suddenly starts not working. It's more about the relevance of the pricing models, are being now challenged by an extreme case, which is reaching expiration. And the more we are in that challenge phase, the less close to reality the pricing model is. Where when you are in a situation in the middle of the cycle, so then the pricing models are working better to represent reality. Where there is this moment in time, it's a very short moment in time, maybe in the last 2 or 3 days, where that distortion starts taking place. Okay, so yeah, never seen it that it doesn't happen. It could. So normally the rule is, when you see the distortion, which typically happens 2 3 days before you roll, if you were to not to see distortion and it's Friday and you know that if you don't roll, you're gonna miss on the time decay over the weekend, so then you just roll, anytime on Friday, and that's it. Cool. Joe, beside distorted Greeks, should price action also determine whether to roll, such as blowing through the short unit, so adding time? Um, I would not go that route, in the sense. I mean, what you say, as always, Joe, makes a lot of sense, and certainly, you have a point. But at the same time, I would not go that route because number one, you're gonna make the management of the trade to be much more complicated. Non-directional trades, have pros and cons like everything else. One of the benefits of non-directional trading is that you know you don't really care too much about what happens. You just wait until it's time to roll or time to manage. But you don't need to be like on top of it, like the climate has changed or more UFOs have been created or that UFO disappeared. So let's do something now. So instead of being on top of it, you are trading in a way that is more relaxed. So if you were to look at price action, for example, to determine when to roll or when to do something in that sense, it will make your methodology a bit more complicated, which kind of goes against the concept of non-directional trading. So I would say that not too good as an idea. But also the real reason why I think is not a great benefit is that because with non-directional trades, most of the times you are dealing with pretty low deltas. Um, Again, for sure, if you are doing a double calendar and then the stock has moved intensively in one direction, then of course you are picking up deltas now. So the direction matters. But again, to me, it doesn't matter too much in the sense that you're still with a pretty low delta overall compared to if you were in a directional trade using, for example, a debit spread, a bull call spread, a bear put spread, a debit spread that picks up direction with a much greater quantity of delta. So um, I would not go that route because even if you do certain changes based on direction, the benefit that this will provide is not that great compared to the fact that you are collecting time decay as well as you are exposing yourself for the increase of volatility as time passes and we are approaching the earnings date. Or if you have a big move on the price of the stock, odds are that volatility is also going up. So therefore, the action that to me would make sense based on price action is, in the case of a double calendar, okay, if you are concerned that price is moving too far and now your options are gonna become in the money or even more than that, deep in the money, and you're concerned about that. So what I would do is that when price moves and reaches more or less where the short strike is, what you could do is just close the trade. Close the trade because the typical shape of a double diagonal is like an M shape, right? So if I look at a risk profile, okay, and let's load, for example, McDonald's. I can sense my computer is running a bit slow after this crazy reboot I had. So if I improvise a double calendar here, two calls above, two puts below. I haven't even looked at the chart. It doesn't matter at this moment in time. So you buy and sell, you buy and sell. The ones you buy are gonna be like, let's say September maybe it's too far. Let's say August, and the ones that you sell are gonna be the front week. Let's say it's gonna be June 9, right? And current price is 285. So let's say the ones above you are dealing with, let's say 300, and let's say the ones below you are dealing with 270. Okay, so let's say this is the trade that you have in your hands. So if you look at the risk graph, it's going to be like an M shape. Okay, see, it's like an M shape. So what happens if the price of the stock is moving fast? Okay, as price is moving up or price is moving down, okay, your initial delta, which is very little, very small, 0.08, okay, your initial delta is going to change. So when you go to the peak, okay, the value for delta, it's going to be, oh, my computer is running really slow since I rebooted. Sorry about that. So the value of delta is going to be here like negative 0.2. Okay, so it went from 0.08 to negative 0.2. So that delta, it's really not doing anything. Now, if that stock moves even more, so now the delta is becoming negative minus 20. In other words, if the stock keeps going higher and you have a negative delta of 0.2, that's directional to the short side, but the stock is going higher. So what's happening? Your P&L is going down, 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 and if McDonald's keeps going higher, next thing you know, you are now entering the red, right? So if that stock breaks the range and goes very high up or very low down, so now you are in the red territory, and on top of that, when you do the rolls, it's less efficient, and all of those things, right? So what can you do in a situation where the stock has moved up by a lot, right? Well, and this is a pretty decent move. $15 move from 286 to 300 is a pretty decent move. So what you could consider doing, and I remember we talked about this in prior sessions, is when you go to where the short strike is, in this case above is 300, below is 270. So when you reach 300, one thing you can do is just close the trade for that profit. In this case, you would have made $190 per contract. Again, odds are that if the stock is moving by that large amount, typically, even if it's higher because the amount is pretty large, typically that historical volatility that you see on the candles will probably reflect itself at least a little bit on the implied volatility of the options. So you are now gaining a little bit of volatility. So that 190 with a little, maybe I went a bit too high. But anyway, you get my point. That 190 now becomes $390 of profit. That was a bit exaggerated, but you get my point. That if the stock moves by a large amount and you close the trade when you get to where the short strike is, you are making your life simple. Is one action, just get out and that's it. You don't need to get into additional roles, or if you are concerned by the fact that now your option is going to be in the money and then future roles are not going to work too well, especially on the put side now, because the put side is so far away that you will never get your 15 cents. You can just do that. That could be a valid rule of risk management for you to get out and that's it. And to me, this is more in line with the philosophy of a non-directional trade, where you normally, plan to not to be too active with the management. And, so instead of looking at, intraday timeframes to try to guess what direction is going to go and decide when to roll, instead of making it so complicated, you can just do it based on either distorted Greeks, or if the stock is really moving a lot and reaches either 300 or 270 in this case, you just get out, assuming the P&L is high. Assuming the P&L is positive, meaning you have a little bit of profit on the table, you just take it out and just find another trade, and that's it. That could be an application. Now, it could be rarely, but it could be that you reach that point and your P&L is actually negative. That could only happen if the stock went there very quickly, like in 1 or 2 days, you never collected time decay. And on top of that, by going there, volatility drops significantly. Okay, so instead of 1563, that was the original value, right? So let's say volatility dropped to 12.6. Okay, so now your 190, okay, it's only $46 of profit, okay, or $50 of profit, something like that, $46 of profit. And that's because volatility has dropped from 15 to 12. If volatility was to drop even more, let's say to 10, right? So now when you get to the peak, you're actually losing money. So in a case like that, then I would not close the trade. I would just, do a roll and, and stay with it, hoping it will come back a little bit. I will accumulate a little bit of time decay. And again, not that I like to use the word hope, even though in this case, that's all you can do because you are in the trade already. You are committed to the risk profile of the trade. And again, you have certain elements that will work in your favor. Time decay is a sure thing. The volatility rising is not a sure thing, but should happen as we are approaching earnings. So staying in the trade is a guaranteed diminishment of risk every week as you do the rolls. And staying in the trade will not be a crazy thing to do, even though, again, coming back to the prior case, if volatility has risen or it's about the same and you get to this price point, so certainly you can exit for a nice profit and you don't even need to wait until the end of the life of the trade. This is another possibility, another application that to me makes sense and will be a bit simpler compared to being very busy with management rules. Okay, but let me know what you think about what I just explained, Joe. If that makes sense to you, or you have a different view or different experience or a different reason why to do it differently. Again, there is not one way on how to trade. There are many ways on how to trade. I'm just sharing how I do it myself and the pros and the cons I see. But I'm sure that we are all experts of our own methodology, and if your methodology is inspired of what you learn and what you do with the UFOs, that's great. But if your own methodology is also some sort of a variation of it that you made your own, then you are the expert of your own methodology. So I could share market experience, but you may have something to share as well. So please enrich us all, because this conversation does not need to be only one directional from me to you. It could certainly also be from you to me, okay? From you to all of us, and for everyone that is listening to this live today or also recorded. Anyway, so let me go through the other questions and comments on the chat. Mark, in the last few weeks, I have been having trouble finding iron condors that meet our criteria. It is so bad that I thought about asking you to go through the steps again. It is not bad. It is normal. Let me explain. And we will see that very clearly when I load the chart of the VIX. Right? So if I load the chart of the VIX, you can see that not too long ago, that was in March, that's not too long ago, we hit levels of VIX of 30. We are now trading at half of that, 16. Okay, 16. So as volatility goes down, you have less premium available. Iron Condor is a credit strategy. Little premium available is not a good thing. You want more premium. So that is disadvantage number one. This is putting you at a disadvantage. The fact that the VIX is going down means that the majority of volatilities across the board for most of the stocks have been going down. Not every stock. Some stocks may have a decent level of volatility, but still probably less than what they had in March. Okay? And while that is the case, okay, I'm just going to go back to McDonald's, since I was using McDonald's, not that McDonald's is special or anything like that. But now, if you look at the tools that we use when we do our analysis, so even though McDonald's got the red line above the blue lines, and it seems that there is a decent amount of volatility in McDonald's, the reality is that because the VIX was high overall in the market, since March. I mean, look at the size of those candles going up and the size of the candles going down. This is a lot of volatility. Then it cools down. But there are certain candles here have very great levels of historical volatility. So what happens is that then the volatilities have been going down across the board, while when looking at historical volatilities, and remember, the calculations that we use on our probability cone are historical volatilities for the last 1, 2, and 3 months. Okay, 63 days, that's 3 months. 42 days, that's 2 months. 21 days, that's 1 month. So in other words, we are going back in time to look at what were the historical, the real volatilities at that time. We predict price ranges into the future based on that. The price ranges, the price projection into the future, it's quite wide ranges because the volatility we had in the last 1, 2, 3 months was not a joke. But while that is the case, the volatility across the board has been going down. The VIX is telling you by pointing at 16 today. So what happens is that you have little volatility given what the statistical historical volatility range suggests it can be. Right? So this is that moment in time where probably 2-3 weeks from now, unless we have another very violent move in the markets, probably 3 weeks from now, 1 month from now, the 21, 42, 63 day historic volatility will be calmer, because all the craziness that took place in March when the VIX reached up to 30, all of that is not going to be built in the price projection calculation. Therefore, the methodology will allow you to trade iron condors with narrower ranges. And even if the volatility is still 16 in the VIX, because the ranges with the blue lines are going to be narrower, now your iron condors will get approved based on the rules of the process, where now the blue lines are projecting very wide ranges, and given the fact that the VIX is 16 and therefore the volatility of options across the board for the majority of stocks is less than a few months ago, so then your application of the iron condors, if you do it the way we do it, the way I've been explaining it millions of times here, so it doesn't give you an approved, and therefore you get frustrated because the rules are not met, isn't it? So that's what's happening. But it doesn't mean that the rules are wrong or you're applying it wrong. It's just that moment in time, where that happens. The opposite is true as well when we go from very, very low volatility environments. Okay, so let's say the market was to behave like this, like nothing's going on. Let's say the market was to behave like that for a long, long time. Okay, let's say that's the case for a long, long time, for like 2 months like that. Okay, what would happen? What would happen is that the historical volatility would be very low as well. The blue lines would project ranges which are very narrow. Because the market is doing nothing, the implied volatility is also very low. So because the volatility is very low, probably you would be very happy to do double calendars. So you would do double calendars with, on paper, very good risk profile graphs. But then the statistical ranges that you would trade would be very narrow, which means that then if volatility comes back into the market after some time, I said 2 months, and that's just made up, after 2 months of price action like that, right? And now the market pushes. So what happens is that the majority of your double calendars would be traded through. Price action would make your short strikes to be in the money, and you would be in the position that we just explained earlier. So there is a moment in time where double calendars and iron condors work beautifully, which is when the market is, let's call it, in balance, where the premiums are high in some stocks, but the volatility levels are, let's call it, normal, statistically normal. And there are moments in times where other stocks provide very low levels of volatility, where also the historical volatility is at levels which is statistically normal. So what happened? Well, now the probability of staying within the range is very high, and therefore the probability of either selling premium, such as iron condors, and keeping the premium, or doing Vega plays with double calendars while you connect time decay and staying within the range, all of those plays are very likely to work very well. And now you would enjoy maybe 5 months in a row where almost every trade meets the rules and almost every trade is a profit. But then you have the situations where market conditions change. And because, price projections, historical volatility, etc., it's all calculation based on past data, there is a lagging effect that generates that situation where your rules may not be met at times when there are changes of market conditions. In this case, the change of market condition is volatility is half of what it was in March. while the blue lines are still representing the historical volatility all the way to March. That's the change of condition I'm talking about. So hopefully this makes sense, Mark. And this is a very good observation. And by the way, I want to congratulate you as well, because the fact that you made that point, you asked that question, or made that comment, represents that you're putting time and effort into applying the methods and spending time in front of the market. And way to go, because this is how one becomes a good trader. Okay, so good job. Very good. Again, today, I would say this is a double calendar day, but is there another strategy that could be considered, maybe a bull call or a bull put? Okay, so yeah, so we can take a look at the market in just a moment. I will do that. Joe said, Mark, the VIX is tanking, coming to a green UFO. The markets could be setting up for a big pullback. Yes, indeed. Very good point. Yes, Jose, I appreciate your insight on this. Thank you for that, Joe. Mark, your feed keeps stopping and starting. Really, I'm not getting what you are saying. Oh, I'm so sorry about that. Not sure what this may be. Maybe you want to refresh your browser if you hear me, or maybe use a different browser. You can also click on the resolution button and change the resolution. Maybe a little bit less resolution will make it work better in case your internet connection is the problem. Not sure if that's the case. But if that was to be the case, that's a possible solution. Definitely recommend you to reboot your routers and modems and networking devices, but of course, don't do it now in the middle of the session. Anyway, so let's go take a look at some market analysis. Okay, we got 20 minutes to go. So let's go take a look at some market analysis. We'll load SPY. We'll do some market analysis, and yes, so we'll do, sorry guys, I was multitasking a bit here. We'll do some market analysis, and from there, we'll see if Mark was right, that today is a good day to do double calendars, but also we'll see if things other than double calendars could be done, okay? So first, speed of the light market analysis. So what do we have? Well, we have an up climate, which is confirmed. And we are looking at candle number 4 out of 5. So we are not in a climate that is already exhausted, even though from a max distance point of view, from a price extension point of view, we have reached already 1.07, where a 2 standard deviation of price action to the upside is 0.81. In other words, that day, that was a crazy day where the speed of movement was statistically unsustainable, and you can see what happened next. So now the problem is that we reached already this unsustainable situation, and now we are reaching candle 4 out of 5, which means that we may still go 1 or 2 more candles, but the reality is that probably we're gonna have to take a little bit of a pause, maybe something that looks like that, or that, 1 red dot, 2 red dots, not even confirmed climate, thin dots, before we keep going. Why am I relatively positive that we'll keep going? Because when looking at the implied volatility of the calls versus the implied volatility of the puts, we can see that there are buyers in the market. Okay, and because we have buyers in the market, so then a normal thing to happen is that whenever is the time, the buyers act, and here we go, the market continues moving higher. So we had a pretty natural reaction here to, I thought, you know what, I in my mind, I was wrong. For whatever reason, maybe it was this other one, I thought we had reached, yes, that was the case. Sorry about that. In my mind, when I do my analysis, I remember this, so that's why I was confused for a moment. So yeah, so we had reached, our speed bump area. So some sort of a price reaction in the opposite direction is to be expected. So I'm not surprised that's happening, especially after such an unsustainable unsustainable candle. The problem is that all of this is consuming time for the climate propagation, and therefore we may need to have like a proper pause, changing from blue to red before we have like a proper continuation. And again, I would be more comfortable getting into doing double calendars, like what Mark suggested, versus getting directional. Definitely, if I was to get directional, I would not plan on shorting opportunities because we don't have the confirmation of a down climate yet, and the blue line is above the gray, which means buyers are in the market. So I would certainly don't think of going short at this moment in time. But let's say you have a portfolio where you already had a long and you close it and you need positive deltas and you have to go long. So finding opportunities to go long, as Mark suggested, with bull call spreads, it's not a crazy thing to do. It could be a valid application of the methodology. Okay, it's not a good, crazy thing to do, even though you should count on the fact that probably the S&P will need to go through either a little bit more sideways action, a little bit of going down with a few of those red dots before we really have an intensive continuation of the push to the upside. That would be my analysis of the market, my expectation, what I would anticipate is likely going to happen given the tools that we use to analyze the market. So again, can you do a double calendar? Definitely. Why? Volatility is low. We are in a position where the climate has not changed yet, but is likely going to change soon. So nothing wrong with anticipating that, especially 107 is more than 081. This is the one data that gives me permission to do that. We are statistically in an unsustainable territory. So that's why. And a double calendar would be my favorite choice. Again, if you need to add positive deltas, you could. Negative deltas, I would say it's very daring. Again, this is just me talking and expressing myself from the point of view of how I trade myself. You may have a trading plan that allows you to do it, and then there is nothing wrong with it, But yeah, that is my comment to you. So good, Mark. I can see that the connection is now okay, so I'm glad to hear that. And then my next question to you guys: we got 15 buying opportunity to go long to get positive deltas there, or would you like me to go over any other questions or comments that you have? Let me know in the chat box, and I will be ready to do that. Jeff, you have been very quiet, by the way. Today you did say hi at the beginning, but you didn't comment additionally. Let me know how is it going. If all is good, just say all good. If you have any additional questions, please do not be shy, and let me know. So just waiting for your message there on the chat box. And if you are joining the session just now, maybe I should have reminded of this a bit earlier, but we are using a chat room which is independent of the webinar room. So our chat could be private and kept anonymous, if you wish, only between us. So then it's not visible on YouTube and places like that. If you are just joining us, so just go to web.speakup.info and key in the room key, which is 44537. Then you type your name and then you come in. Okay, and then we can chat in a way that is anonymous. Jeff, all good so far. This is great. And Mark said all is good now. Okay, so yeah, so I guess that what I'm gonna do is go ahead and look for some opportunity to be a buyer based on what you've done, what you said. We got 15 minutes to go, and we should have time to do this. I mean, it's plenty of time to do it. It's just that I need extra time because I need to explain it, isn't it? Cool. Okay. So let's begin. What do we have first? I want to go long. So I'm going to start with advanced option scans. And I want positive CIV spread. Ahmed, I am so sorry, my friend. I should have thought of that. I am so sorry. maybe I should leave some sort of a ticker on the bottom part of the screen or something in future sessions. So I'll think of that. Certainly there is room for improvement there. Oh, wait a moment. Mark was saying, I checked the options volume map. The next four expressions are all more than 1.5 or higher on the call side. This is why I thought a bull call would be a possibility. And this is very smart, Mark. Very good application because, again, You got the climate in your favor, even though careful with that 1.07 number. But also you have the implied volatility in your favor, blue line above the gray. So again, there are buyers in the market. If on top of that, the volume map is showing you plenty of signs of buyers now, right, in the next 4 expiration dates. So we may end up with a case where the climate will expand beyond what probability suggests, like what happened there, in April. That could happen. And you have this beautiful continuation of the move. That could certainly happen. Okay. So it's less likely that if that 1.07 number was not there, but certainly the fact that you're using additional tools, it makes a lot of sense. Now, the only danger there, and I will mention it quick, is the fact that you may be looking for excuses to bend the rules. So if in your trading plan you have rules around how to use the volume map and when, that's great. If you don't have the volume map on your trading plan, but you want to find an excuse to go long, and the volume map just gave you the excuse, but it's not part of your rule set, and you have a very specific way on how to read it and what numbers you need to see for you to approve it, so then you are not being systematic and careful. It may bite you in the future. So what you said makes a lot of sense. I like it very much. If you don't have it as a rule, make it a rule. And if it's not a rule, then don't use it, even though I like it very much. Make sense? Very good. So anyway, looking for a long trade. So looking for stocks with positive CIV spread. Because volatility is low, I would also want to look for stocks with cheap options. So CIV mean less than 20. Because I want to go long, of course, I will want my rotation to point up. Okay, so what do I want? So I'm going to be a bit exaggerated here by asking, I want everything up. Okay, of course, the probability of finding opportunities like that is very low. Okay, I just clicked on scan. Let's see what happens. My computer is running very slow since my reboot, guys, so I'm sorry about that. This should be way faster. Okay, so we got nothing. Okay, so that was very exaggerated. Okay, as I said. So what if we look at no mid, long, and rotation? Nothing. What if I look at long only? Now we have a few. Okay, so I want to start with this. Okay, then we want, I don't have anything here, right? Correct. We want earnings to be 30 days or further away. And then, of course, we want a nice climate condition. Oh, wait a moment. I had climate down here. Let me uncheck climate and check this again. So I'll come back here. Let me check those one more time. Okay, yes. So rotation, mid, and long term, I have 4. Okay, so now are those giving me anything good with the climate? So do we have any climate up that is sensible on the daily time frame? Do we have any? Yes, ENPH. I have not traded that stock, so I don't know if that stock happens to be liquid or not. Let me come here. ENPH. So yeah, good climate condition. Yeah, I mean, to be honest, the trade setup is pretty nice. This is kind of like technical analysis, cup and a handle. If it breaks this thing, yeah, there's plenty of room for that stock to rally. Now, I am not aware of the liquidity conditions of that stock because we have not that much time. I'm just gonna go for the strategy builder and see what I see on the strategy builder. So we had the bid 955, 975, 620, 635. But actually, it's not too bad. Again, I have not traded that stock. I have not traded this company, but it's not too bad. Liquidity is not too bad. Okay, so let's look at the chart with a bit more detail. If I was to project a target from here, it will look like it's here, where it's reacting. Okay, so that is that. And then if I look at, yeah, this is the daily time frame. Next UFO is located all the way up here. If I look at the 2-day time frame, so the UFO is 204, which is a little lower. If I look at the 3-day time frame, is 314. So 204 looks like an interesting location. 204. What about in the intraday time frames? In the time frames, there is really nothing all the way until 220. Okay, so I guess 204 would be a good price point where to plan an exit. So if I do that, 204 more or less here. So I'm gonna send to strategy builder and see what do we have. So July 26 expiration, time to target 629. So we take, this is a 1 month trade. Okay, 1 month trade. Again, looking at the liquidity conditions, it doesn't look too bad. It really doesn't look too bad. Open interest, we got some volume. It's not the best stock in the world, but this is indeed tradable. Great. So look, I have not traded that stock, but it's indeed tradable. So let's say you have an account size that allow you to raise $300 per trade. Okay, so you are left with these particular trades, and the one that seems to perform the best is the bull call spread made of buying the 185 and selling the 190 put. Okay, 185, 190. Yeah, so slightly out of the money. This is the type of trade that would produce a very, very good performance. Okay, you can see here the size of the red versus the size of the green. So very nice. Again, starting the trade with that could be very useful. And then as the stock rallies and you're approaching the target, you could certainly convert this into an iron butterfly, for example, by selling another call against and buying a call above. And, that would be, potentially a pretty powerful thing to do. Any question about this trade? Any question about this trade? Would you like me to document it? So we're talking about a debit spread on ENPH, where earnings are happening on July 25. July 25, where we are using expression July 21st. This is the expression that we selected, right? Yes, July 21st, and we are buying the 185, selling the 190. Entry could be any time. I mean, I'll make an extra comment about the entry. Given the fact that we are hitting that particular speed bump, odds are the stock would retrace a bit. So when the stock retraces a bit and is coming closer to the moving average, in a perfect world, you even have green UFO. That would be perfect. But again, I am under the assumption that your portfolio needs long deltas because, again, given what we saw on the market conditions for the S&P, it is not the exact perfect time to load on long positions. It's not crazy, but we got that number 1.07, remember? So it's not the perfect time. So because it's not a perfect time, if you are doing it, it's because you need positive deltas to balance out your portfolio. So then, even though the stock is moving higher, I may have to retrace before it keeps going. Well, if you need the positive deltas, you could take the trade now. That's not a crazy thing to do. And based on that premise, and then when we reach 204, as we said, that's what's going to be our target. So you will want to get out. This trade will have a maximum risk of $300. To be precise, 185. 185. Okay. Yes, delta is very low, Ahmed, because this trade is a trade where we are buying bull call spread, which is out of the money. Okay, so you're buying the current price of the stock is 177, and we are purchasing the 185. So by doing that, you are making your trade very cheap, and therefore the risk of the trade is little, but you are aggressively directional. You have a very little delta now, but the moment the stock rallies and goes, 185 and above, which the target is 204. So if you're right, you need to go above 185. If you're wrong, you're going to lose 185. That's it. But if you're right, you will go above 185 because the target is 204. And at that moment in time, delta are going to pick up lots of power. And again, this is a trade that produced the best performance out of the planning done on the strategy builder. Now, of course, it has the disadvantage of being an out of the money debit spread, which means that if the stock goes down, you cannot do anything about helping the trade to do better. The only thing you can do is to sell options against and convert it into an arrow butterfly or a butterfly. And then if after going down the stock was to go back higher, the deltas will never become decently positive, and then this trade would be almost guaranteed to be disappointing. So yeah, that's the downside of doing a debit spread, which is out of the money. But the beauty is that the cost is very low. So if you're using that as a hedge, it doesn't hurt your portfolio if you have other positions running at the same time. The other positions are going to do well. Well, you're going to lose 185. If the other positions don't do well, this 185 trade is going to pay you very well, because the moment you go above 185, it's going to, which is funny because the cost of the trade is the same as the strike. It's just a coincidence. But the moment you go above 185, deltas will kick in and the trade will start performing very powerfully. So if you were to do a trade which is directional only, and that's the only trade you have in the account, I'm with you, Ahmed. I would prefer to have more delta. But for this type of application, this is actually a valid way to approach it, with the pros and the cons I just described. Nothing is perfect in life. Nothing is perfect in trading. This particular application has the benefits and the disadvantages I just mentioned. Okay, so your point is absolutely spot on, but hopefully I also made sense, and you see why I did it this way. Mark, I came up with ENPH yesterday on 144 time frame. There is a green UFO at 166. That is my entry. That is much better, more patient, wait for the market to come to you. That's a good analysis as a preparation for when they come, because, sorry about that. If I'm right on the market analysis we did on the SPY, and now the SPY is going to take a pause and it's going to become a red climate for a day or two or three, and then comes back to blue, well, guess what? 1 or 2 or 3 days going down may bring the price of ENPH to that 166.88 price point that you want to see trading at. Okay? And if that's the case, you need the market to fall for that to happen. If you need deltas because you're hedging, because you have other positions in your portfolio and you need to add positive delta and you need it now, so the entry then is now. To mitigate the problem of entering at a less precise time, I'm using out of the money debit spreads because they're cheaper. So if I'm totally wrong on the direction, because it's not the ideal time, so at least I risked less. That's the philosophy. I'll take a sip of water, guys. Very good, Mark. Entry has not hit yet. I put it on again this morning. Buy 175, sell 180. Got you. Understood. Good job, guys. Good job. Good comments. Good session. We just reached the ending time for the session. Always a pleasure. Always a lot of fun. Love the teamwork. Thank you for your engagement and collaboration and participation. Thank you for the hard work. Thank you for being part of our community, of course. And yeah, I mean, we all enjoy this, isn't it? So thank you so much, my friends. I will see you soon. I will see you, I believe is if not next Monday, the Monday after, with the open meetings. Keep up the good work. If any question, email me, send messages to the forum, and let's stay in touch and let's keep killing it and let's keep doing what we do. Take care, everybody. See you soon, my friends. Bye-bye.